Welcome. We'll get started shortly. Before we begin, here's how to earn continuing professional education credit for attending this session. There are no polling questions or attendance checks. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz using the Earmark app. Visit earmark.app in your web browser. You can also download the mobile app by scanning the QR code on the screen. Log in, or if you're new, create your free account. Be sure to use a valid email address because that's where we'll send your course completion certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. Complete the quiz to earn your CPE certificate. It takes us a few days to create the course on the app, so if you are attending this session live, please wait a few days. We'll email you a link to the course when it is ready. If you have questions or need help, email us at support@earmarkcpe.com. And now, on to the event.
Welcome, everyone. Thanks for joining us today or watching this on demand. I am Zach from Earmark, and this is Working with Real Estate Clients, Advisory Value Beyond Compliance. I'm going to hand this over to your instructor for today, Kyle Paxton. So, Kyle, please take it away.
Thanks, Zach. Happy to be here. Thank you all for joining. This is a topic that really excites me, and you'll see a lot of passion come out here. So I'll apologize in advance. I'm probably not going to win any design awards on my slide deck here, but I'll bring the heat verbally here. So for my visual learners, I'm sorry, but I can meet you after the presentation here. As Zach said, my name is Kyle Paxton. I'm a tax director with James Moore & Company. I am located in Tallahassee, Florida, and we work with real estate companies of all shapes and sizes. As an accounting firm in today's environment, we're pivoting more and more into the advisory world. And so what I want to talk about today is really working with real estate clients, how to be that trusted advisor and really elevate your value beyond just the compliance side. So that's really what we're digging into today. I want to take a minute and just talk about why this matters. We're seeing more and more clients are asking for cash clarity, right? Real estate's often in cycles. We came off of COVID. We have, financing constraints currently. There's a lot ever evolving in the real estate space. We're constantly looking at cash clarity. And a big factor of that is the taxable implications of transactions and how deals are structured. So as accountants, and if you're in the tax space or wherever you live in that, we really have an advantage in the advisory space where we can really see the full financial picture and use that financial picture to elevate our clients and the folks we work with. So there's more deals and financing decisions happening right now. I talked about refinancing constraints. There's been a lot of debt that's been refinanced in the last couple of years as of this recording. And so we really have timing sensitive planning opportunities. One big component of this is in the advisory space is with the rapid development of artificial intelligence and advanced technologies, we have a massive amount of data at our fingertips that we can apply to clients across industries and specifically in the real estate space to really level them up and bring that value we're bringing. So the learning objectives and things I'm going to talk on during our time together here are really how do we master complex real estate tax strategies? I talked about how this all comes back down to cash, right? Real estate is a cash business, a cash flow business. And so a big component of that is making sure you have the liquidity to pay your tax liability. You have strategies implemented to minimize that tax liability. And most importantly, from my background as a tax advisor is while we have all of these tax strategies available, do they really marry with the economics of the deal, what your long-term goals are? And we don't just get caught up on the Instagram post or whatever on how to save a bunch of tax if it doesn't make sense. I mentioned we're going to dive a little bit more into advisory value beyond compliance and how we're taking data and turning them into recommendations. And then ultimately, the overarching thing here is as advisors, we are trying to strengthen our client relationships. I tell clients all the time, I want to be a part of your business. If you don't want me to be a part of your business, you and I aren't going to be a good fit together, right? I want you, I recognize, financial matters are sensitive and they're personal to you. I want to be in it. I want you to see me as that trusted advisor. Let me in, let me see how you're working and bring my expertise from working with other clients and my knowledge of the industry into your business to help you and your business be better. So I'm going to take a moment, and I don't want to talk about these market snapshots in detail, but the point I'm establishing here is what I mentioned before, really, is that ultimately as advisors, everything we're doing needs to tie back to economic reality. Again, I see so many practitioners and advisors get caught up on a tax law change, and it's the low-hanging fruit and the buzzwords that get thrown around. We're going to talk about more in a minute. But really making sure everything that we're doing is rooted in the economics. So in these conversations with clients, everything comes back to key metrics, right? And those core numbers that every real estate professional knows that we can root in: mortgage rates, cap rates, and then just overall trends in investment activities are areas in which we continually gravitate back towards in our conversations. So it's not just settled on how do we meet a bank covenant, how do we minimize our tax liability, those more compliance type things. We really want to understand the economics, how we're going to make money, and what we need to do to help optimize our full picture in order to do that. I talked about how we don't want to focus on the low-hanging fruit and the shiny object, but I do want to touch for a couple minutes on the tax law changes, right? So as advisors, and again, I'm coming from the tax side here, one of the biggest planning opportunities we have in the real estate space right now is coming off of the back of the One Big Beautiful Bill Act. This video is being recorded in spring of 2026. We are coming off of significant tax law change in 2025 under the One Big Beautiful Bill Act. And there are some big levers for real estate here that have both positive and potentially negative implications for our real estate professionals. So talking about bonus depreciation, 163J, the interest expense limitation, timing of energy incentives. So the advisory focus in this is being proactive and getting out in front of when these triggers either come into play or can have the most impact, and being able to work through our clients to give them the proper heads up on what's coming, what's changed, and how these things impact them. So talking about this in a little more detail, a big ticket item here is bonus depreciation. And this is probably that buzzword I get the most in the real estate space, right? And so what bonus depreciation is, if we take a building and you have a 39-year commercial property, bonus depreciation is a concept where the internal components of the building are those smaller objects. So your light switches, your door, potentially your door, your furniture over a certain cost is all eligible for accelerated depreciation provisions. And you can potentially get 100% cost recovery in year one as a tax deduction under the One Big Beautiful Bill Act. So this came into effect after January 19th, 2025, and it's ongoing indefinitely, barring another law change. So really, at a high level, there's a lot of opportunity here. Depreciation is a timing difference, and it gets back to the cash flow game. We talk about how real estate is a cash flow activity, and real estate inherently is illiquid. So it can be often hard to get cash out of real estate. One way in which you can potentially free up cash is through the bonus depreciation provisions. And in doing that, you are accelerating that depreciation deduction you would normally get over 39 years in a commercial property and front loading it. And what that's doing is it's potentially reducing your tax liability on the front end of the life of the property that you're holding to free up that cash now that you can use to invest in other properties, pay your accounting fees, whatever it is, and free up cash in that way. And so that's a mechanism we're using a lot. So we'll talk more about cost segregations in a little bit, but one big advisory focus here is how can we take this 100% bonus depreciation for both capital expense planning, buying new equipment at year end, getting that cost recovery in the year it's placed in service. And then on a broader scale, when we have these big parcels of real estate, what can we do to accelerate the deductions associated with that real estate, free up cash now, and then use that to achieve the rest of your goals? 163J, I want to talk about this for a minute because this has been a pendulum back and forth the last several years coming off the back of the Tax Cuts and Jobs Act. So this is a sneaky one, and it gets people in the real estate space. So Section 163J is a mechanism where your business interest expense is potentially limited. For our real estate folks, this is generally mortgage interest or interest on debt securing the underlying property. If you're considered a large taxpayer and don't meet the small taxpayer exemption, or the big catch that gets real estate is the tax shelter rules, your interest is potentially subject to limitation. So talking about the tax shelter component for a minute, this is a big one. So we work with a lot of real estate investment funds of shapes and sizes, right? And what I would consider kind of the standard real estate investment fund setup is you have general partner, they can be however many, owning roughly 30% of the profit and loss of a partnership. And then the remaining 70% is split amongst limited partners who are the ones that are actually contributing the capital to front the transaction. The general partners are getting the upside, are getting distributions, for their management of the property and kind of ongoing services in that regard. The limited partners are getting a return on their capital. Everybody's happy. The catch here is that the IRS treats these funds where more than 35% of a taxable loss is allocated to limited partners as a tax shelter. And that in itself kicks in Section 163J. So when I'm tying in that 100% bonus depreciation we just talked about with the 163J interest provisions, if you're accelerating depreciation in a real estate fund, you potentially create a taxable loss that's not necessarily tied with economics, right? So in year one, you have a large taxable loss driven by real estate that can pull you into these tax shelter rules. The planning opportunity here with the interest expense is getting out in front of this, understanding what the changes are year over year. Before tax years 2024 and prior, for the last couple of years, you haven't been able to add back depreciation and amortization to the limitation for interest, and it's created an environment where a lot of real estate entities have their mortgage interest limited. Fortunately for real estate entities, there's a carve out. You can make an election as a real estate entity to, quote unquote, get out of Section 163J. But the trade-off is that you have to change the method in which you're depreciating your assets. So the planning opportunity is tying in that 100% bonus depreciation, the 163J interest triggers, figure out which is better for us. Do we deduct all of our mortgage interest expense? Do we get to take that depreciation? This is actually a positive of the One Big Beautiful Bill Act, where we have the add back for depreciation and amortization back to the limitation. So we're seeing this less with our real estate entities. But when I'm onboarding clients and working with new folks, I see all the time that it's missed, where we've had prior advisors not catch that tax shelter provision, and that can manifest in several different ways. And then one other thing we look at with the advisory side here is, we look at the 163J rules in connection with refinancing. How does refinancing our debt impact these calculations? And what do we need to do to get ahead of any cash flow modeling and things like that would be impacted by that? I'm going to touch on this one briefly because it's going away, but this is one of the downers for the One Big Beautiful Bill Act for our real estate folks. So again, as of spring 2026, when this webinar is occurring here, we have a lot of provisions that are about to expire, energy incentives. So if they're not moving, they need to be moving now, and making sure the advisory focus is making sure those construction schedules, certifications, and documentation are tied up in advance. of these deadlines. We work with a lot of firms who help kind of do the work behind these energy incentives, for lack of a better term, and they're pushing them hard right now to get them over the finish line before these expirations kick into gear. The last tax provision I want to talk about before we pivot here is the opportunity zones. So opportunity zones came to fruition under the Tax Cuts and Jobs Act in 2018. And the One Big Beautiful Bill kind of revives the opportunity zones. So we've been calling them Opportunity Zones 2.0. So the intention here is that there is incentive for real estate investors to invest in areas that have been designated as opportunity zones that generally need an economic boost. And so there are beneficial tax provisions carved out around those specific tracks to incentivize investment in those areas. The original rules for qualified opportunity zones had a gain deferral provision to where if I had a $1 million capital gain on the sale of stock, I could turn around, put $1 million into a qualified opportunity zone. And that $1 million gain I had on the stock was deferred to 2026. As of the time of this webinar, 2026 is here. So we have a lot of clients who invested in these qualified opportunity zones years ago, and now they have a $1 million gain event coming in 2026 for the gain deferral. There's plenty more there from the tax incentives part where you get a step up in basis after holding the property for a length of period. And so, there's a lot of economic reasons in which investing in an opportunity zone makes a lot of sense. But that gain deferral is kind of the bright, shiny object that drove a lot of people into these investments early on. With 2.0 here, the changes are really, okay, we're eliminating that 2026 sunset where the opportunity zones go away. The gain deferral or the gain trigger for those previously deferred gains still occurs in 2026, but then in 2027 onward, this program has been extended. So now the gain deferral is a rolling 5 years. So whenever you have that gain event, if I sell $1 million of stock in 2028, I invested in a qualified opportunity zone, I have that $1 million gain deferral for 5 years, and that rolls on and on. And then in 2.0, they also built in provisions that incentivize more rural investments in qualified opportunity zones. So this is something I'm very curious to see how, that drives investment into more rural areas. But I have plenty of clients who are factoring this to their plans that were generally already in existence, or, they had started thinking about making rural investments to really say, okay, is this mechanism, this gain deferral and step up in basis provision, what really drives that? Pushes the investment over the hump and makes it worth it for us. So a lot of conversations about this. We've kind of been in a dead zone for 2 years on qualified opportunity zones where that 5-year gain deferral wasn't we didn't have the 5-year gain deferral because it was always coming due in 2026. So the fact that that's happening now is big. And then one other planning kind of advisory opportunity tied around this is that every 10 years, the zone designations, so those areas that are designated of opportunity zones are going to be rewired. And so an advisory opportunity here is making sure that what you invest in stays in the opportunity, stays within these rules and doesn't get rewired every 10 years. So something we're watching. We don't have a lot of guidance on this yet, but there's plenty of opportunities for advisory in this. Again, I always want to step back. I've spent about 15 minutes just talking about tax. All of these opportunities in the tax world need to be rooted in the economics, and does the deal actually make sense? And so as a business advisor, you see how excited I get talking about the tax provisions, but we have to take a step back, really look at the big picture, all the other real estate investments, and figure out if each of these tools makes sense for the broader picture. And just as important, the timing of these tools. How does that play in with everything? So this is what I've been harping on kind of the whole time here, right? The advisory playbook for real estate clients is really taking the inputs, looking at the tax levers, tying those back to the cash impact, and then making the decision. And oftentimes that's in the acquire, hold, exit realms there. And so that's the playbook we run back time and time again, and we'll talk through more of what that looks like on an ongoing basis. All right. I want to talk about here a couple advisory strategies that, while again rooted in tax, are really more focused in holistic advisory and cash flow planning. So when I'm working with a new real estate client, the number one place I start and spend about the first hour on is entity structuring. And do your real estate investments, the entities they're in, make sense from I'm a CPA here. I'm looking at it from the tax side, but from the financial side of things, does the entity structure you have set up around your real estate investments make sense to help accomplish your goals? That's a lot. That is a lot of conversation there. A lot of different ways we can go about that. So for me, this is 100% the starting place for real estate advisory. Unpacking that entity structure and making sure it makes sense from the financial side. And so when I'm looking at real estate, the low-hanging fruit is that real estates are often held in partnerships. And I'm talking about partnerships from a tax perspective here. The legal vehicle can vary. Several different types of legal entities can be taxed as partnerships depending on the state you're organized in. But from the tax IRS perspective, organizing as a partnership gives you the most flexibility around your real estate investments. So the partnership structure allows for you as an investor in the partnership to get basis in your partnership interest for both any capital you've contributed and your share of debt in the property. So a lot of real estate is leveraged, right? And so you have that mortgage on the real estate. So you can get basis in your partnership interest for that your share of the mortgage. And what that allows you to do is it allows you to potentially take distributions out of the partnership to you personally, pulling cash out of the investment vehicle, and deduct real estate losses against that basis. We get back to that kind of classic real estate fund example where the limited partners have their slice of the pie, and then the general partners who haven't contributed any capital in the deal can still take real estate losses against their share of the debt. So fundamentally, partnerships from a tax perspective are the most advantageous vehicle for most real estate. And I'm talking long-term real estate. It gets a little nuanced with your short-term rentals, the Airbnb, VRBOs of the world. But for our long-term rentals and real estate investment holds, partnerships typically give you that most flexibility. These can manifest in a lot of different ways. So we can have tiered partnerships. There can be 5 levels to the partnership. My friend Joe can be in tier 2, and then there's 3 more partnerships that go down to Kyle. So I love this stuff, and I love unpacking this and understanding what are the economics. How is the cash going to flow out of this parcel of real estate? If there's rental income, who gets the rental income? When the property's sold, who gets the cash related to that sale, and making sure that the entity structure really aligns with those goals. That's always done in connection with legal counsel and attorneys for all the legal components that come out of that. But there's so much to unpack there from the financial side. Then you really look into the partnership structure allows for a lot of freedom in how taxable matters are allocated. So this gets back to cash flow, where we're taking our, we're using these tax levers, how these losses we're generating with depreciation or otherwise are allocated. It has to match up with the economics and the waterfall of who's getting the funds, out of this real estate. But partnerships give us a lot of flexibility to set that up. So I will often see new clients I'm bringing on that who are either given no advice or poor advice on how their real estate investments are structured. And this is kind of the immediate thing here. The other thing I want to take a minute to harp on is that within these entity structures, the operating agreement is super, super, super important. Time and time again, I get new clients come in that maybe own a parcel of commercial real estate with their spouse or their best friend or 17 of their best friends, and they don't have an operating agreement in place. That can cause so many issues, of course, from the legal side, but also from the tax and economic side on how is money actually coming out on this, and if something goes south, what happens? How do we rectify problems with that? So the other thing that we see sometimes is that what real estate investors think their operating agreement says doesn't necessarily align with how it's actually worded. So this is an area, again, where with new clients, it's the initial questions are always, how is this thing structured? And then give me operating agreements for everything you have. And if you don't have them, find an attorney and figure out how to make them. And by the way, I'll help advise on all of the tax provisions and the financial side of everything else. So there's a big advisory opportunity there in setting it up. So this is all just proactive advisory. It's getting out on the front end of no surprises. When that property is sold down the line, we know who gets the cash. We know how it impacts. And then all along, I've been educating my clients who are educating their other investors, or I'm educating the investors directly on, hey, you're getting this depreciation benefit now. Come down the line when we exit, you're going to have a taxable event that recaptures that depreciation. Here's other strategies we can employ around that. So it's really creating this holistic advisory that starts on the acquisition phase to say, hey, pump the brakes before we buy. Does the entity structure for this real estate investment make sense? It does. Boom. Okay, now what happens while we hold? Everything's good. Boom. Okay, now what happens when we exit? Unpacking that. Boom. Lots there and a lot of opportunity, and it follows along kind of through the whole cycle of the real estate investment. I've talked about this, so I'm not going to spend too much time, but this is a big opportunity that we see time and time again on the back of the One Big Beautiful Bill, but cost segregation. So again, we're playing with cash flow, we're playing with time value of money, but it's taking this $22 million parcel of real estate, accelerating 6 million, the numbers are small on my screen here, but about 6 million of that into property that can be accelerated for depreciation purposes. So before cost segregation, you are taking a deduction on whatever portion of 22 million is allocable to the building over 27 and a half or 39 years, depending on the type of property, and you're pushing it into a year one deduction. We are freeing up cash that we can do stuff with. Again, my caution here is this is all time value of money. So down the line, when we exit this property, you're going to have to recapture that initial deduction. But the advisory component in this is all about freeing up cash flow, and when does the timing make most sense? If you have a year where you have losses and everything, does it make sense to accelerate your depreciation when your effective tax rate is 0 or 10%? Or do we wait till next year when you make it big, you sell a bunch of stuff, and you're at the top tax brackets where you get more bang for your buck? So aligning, okay, here's when we actually want to place this into service. We want to do the cost segregation, kind of the rest of your picture. There's a lot of moving parts there. Big opportunity for advisory. The other area where we see this come up a lot, in the advisory lens is both like communication with the financing teams around the financial picture, right? I have conversations just about every day with banks on how do we interpret these things. And so with the depreciation and cost segregation conversation, where we're accelerating these deductions, how does this impact our numbers, and how do we explain this to our stakeholders? And so again, this is a conversation we have a lot, where you have a potential deduction on your financial statements and tax return that's not tied to cash, makes our numbers look really bad from an operations perspective. So there's an art to being able to kind of talk through those things and communicate those effectively with the stakeholders. So it's an opportunity for me to educate my clients in how to have those communications, and then also just handle them directly myself. Lots there. Good stuff. And then last but not least, the 163J interest expense. Again, We want to make sure that as we do these other kind of strategies to free up cash flow and accelerate deductions, how does it interplay with the rest of the tax picture and the other kind of triggers that occur in here. And the last thing I want to talk about is getting into a little bit on, in this last thing in this area, is talking a little bit about estate planning, transition planning, 1031 exchanges. So quite often, as I'm working with clients who have more robust real estate portfolios, there's a lot of them that are right about retirement age right now, right? And so in looking at exit and slow down, another conversation I have just about every day is, hey, I'm looking to slow down. I don't know what that looks like for me. I can't imagine, what slow down looks like, but what tools might be available there. So in the current environment, and start thinking through estate planning and unpacking estate planning, which is big for our real estate professionals, we start thinking through how do we transfer wealth to the next generation. So I have so many clients that are sitting on land, building, multifamily property, whatever. They bought years and years and years ago at a very low basis, and they're looking to slow down. If they sell, they trigger a large taxable gain because the value's appreciated quite a bit. Real estate's been a pretty solid investment over time, right? And so these conversations are rooted a lot in, okay, what is our end goal here? How do we want to transfer wealth? When do we want to transfer wealth? Do your kids want to be involved in this at all, or are they trying to get out? And so oftentimes that conversation gets back to 1031 like-kind exchanges. And so in looking at this, I find a lot of my clients in this space have built up wealth both within real estate and then kind of have parlayed that into other areas. So while real estate's the illiquid investment, they've built up wealth in liquid assets that they can draw on during their retirement. You get to that conversation on, hey, I don't need the cash that's tied up in this real estate, but I want to pass it down to my kids. So one big way to do that is through the 1031 like-kind exchange. And so whether that is there's a specific property you want to exit and you don't want to manage that anymore, or you want to turn that into potentially a different type of investment where you have less control, there are options there. So at a high level, if you're not familiar, 1031 like-kind exchange is you exchange, you relinquish a property, you have 180 days to, you can't touch that cash, it gets held with a qualified intermediary, you put it into another property, typically equal or greater value, the cash plus the debt has to be, greater or equal value to avoid a taxable event, but you can have a full gain deferral on the sale of your exited property. The mechanism to which trues that up is that your basis in the replacement property is reduced. So if you go and sell that, tomorrow, you have a larger gain. But the idea here is you can exit a property and get into a different investment without triggering gain. This happens a lot, right? At that slow down age, or we're talking about, hey, I want to exit this particular investment, but I still want to be invested in my real estate for my kids. You don't want to gift it now because your kid's basis becomes your basis in that really old property. I want to hold it until I pass and get that step up in basis. And so the 1031 like-kind exchange works for both kind of just exiting that individual investment. And then, as I mentioned before, it opens up a door to different types of investments. So one example is a Delaware Statutory Trust, DST. And how DSTs function are, they're typically a package of different types of real estate. So it might be an Amazon warehouse and a multifamily property that are located in different states, totally unrelated, packaged together. DSTs are structured in a way in which they're considered like-kind property for this. So I can exit a multifamily property I've owned in a partnership, the partnership can sell a multifamily property it's owned for years. And turn around and do a like-kind exchange into one of these Delaware statutory trusts. Multifamily property, Amazon warehouse don't necessarily look the same for what I would think like-kind is, but they are considered like-kind for this purpose. And so with the Delaware statutory trusts, this is a great option for those folks that are, around that retirement age. I want to slow down, whatever, become less active in my real estate investments, to where you can parlay your real estate investment into another real estate investment that somebody else has control over, still be invested in real estate, get those, monthly payouts from rental income. And then eventually the DST exits, sells the property. You can do a like-kind exchange again into whatever your next real estate adventure is, whether that's another DST or another type of property, multifamily, commercial, whatever. And so this is just one example of a strategy that we see a lot, to where Kyle Paxton, retirement age, is ready to relinquish control, loves investing in real estate, just doesn't want to handle it directly anymore. 1031 exchange into a Delaware statutory trust. If Kyle passes away tomorrow, my kids inherit that interest in the DST. Their basis becomes the fair market value as of the date of my passing, as long as I'm below the estate tax exemptions, which are quite high in 2026. They could sell it tomorrow and have no gain. So I've got a little long-winded here, but getting back into where the advisory comes in here, it's how can we, as we get older in age, and as we are looking to change our portfolio a little bit, or quote unquote slow down, how can we keep the investments cash flowing in a way that sustains the lifestyle I want in retirement, while also understanding that if I can hold on to it until I pass, and then pass it on to my heirs at that point, there are significant tax savings for my next in line there, by structuring that in a way. So looking at this big picture on what are our cash flow needs, working with the wealth management team and projecting that, working with legal on making sure, the real estate entities are structured in a way in which you're protected from the legal side, and then being able to chart out this whole estate picture is a huge opportunity for advisory right now. And as I talk about this, just a lot of times this comes back to entity structure. Real estate's often invested with your pals or those limited partners or whatever. And so we can structure this in ways to where some people might want a 1031 exchange and some others. That's a loaded topic I'm not going to get into in detail, but there is some flexibility in getting back to kind of that partnership structure and being able to craft these investments in a way that makes everybody happy on exit. Okay. I'm going to wrap us up here talking about what an advisory cadence might look like. So I'm harping on this being advisor to our clients, right? And that advisory can manifest in different ways from a timing perspective. And so really the idea here is, as an accounting firm, James Moore and Company, and I know several others, are trying to get away from just, hey, here's your tax return, have a good day, see you next year. And much more into, as I said on the front end, make me a part of your business. Help me help you. And it saves a lot of headaches all the way through. So in looking at what a cadence might look like on what you can do monthly here, I'm not necessarily going to read all of these in detail, but what I really want to start getting to is, as advisors, we have to find a way to get relevant data now. And that is like today's data. The tools are out there so that we should be able to get real-time data on any investment that's a week trailing, couple days trailing, everything else. From my perspective, gone are the days where the monthly close happens 3 months later. It should be like 10 days after month end. And then every software under the sun is out there for our real estate investments to get real-time data now. We do a lot of advisory in this space. And often we come back to, just as an example, Yardi. Yardi's a software in which you can pull in property management, the accounting functions, everything under the sun related to your real estate investment, and have users get real-time data right away. So what I want to get to here, and what I'm working to get my clients to, is that on a monthly cadence, we are hammering through that monthly close. We're doing the reconciliations, looking at AR, working through all of those things, tying out the schedules quickly. So then we can quickly get to, all right, where are we at budget versus actual, looking at some of the less, strictly financial perspective, digging into the rent rolls a little bit, looking at occupancy, how can we optimize that? All of this can happen with data from yesterday now that everybody can see, including me as that outside annoying accountant saying, make me part of your business. And so the tools are there and the processes are there. It's getting that recurring frequent cadence to where we are sitting down together and saying, hey, what happened last month? What do we expect to happen this month? And what's going to change? Where can we get stuck? And this all gets back to just mitigating cash flow surprises down the line. We will do this frequently with our clients, or we will have a meeting every month and look at that. Where are we at? Where do we need to be? And what changes can we make in the next month to optimize that? A lot of times in real estate, particularly in kind of the small, we'll say family office style investors, there's a few key people and it's a pretty lean team. So to be able to come in and say, hey, I have the expertise in these areas. I can help you optimize these systems, expedite that monthly close, do those rent roll sanity checks, adds a lot of value to the clients. And so we've spent a lot of time internally optimizing our systems to make sure that we are positioned to be, the expert advisors in this space and really be able to stay on top of and leverage real-time data to help our clients make better decisions. Quarterly, this is where we get back to my old favorite topic, right? The tax forecast and really looking through estimated tax payments. Where are we at compared to expectations? What CapEx do we need to invest in before year end in order to mitigate our tax liability? Then quarterly, we're looking through that covenant review. And again, making sure we're in compliance with all of our lender obligations. And I mentioned it before, but deep diving more on a quarterly cadence into those CapEx needs. What equipment do we need for our business? What can we do from a cost segregation, bonus depreciation perspective to optimize our picture? And then the biggest thing for me on the quarterly basis is just sitting down with a client and saying, hey, what's new? Because inevitably there's that deal they invested in, the deal they're thinking about exiting, the deal they handshook with Johnny with last week that I didn't know about. And if I know about transactions on the front end or any significant changes on the front end, it's a heck of a lot easier to be proactive in all these advisory topics we've talked about than hearing about it on the backside, right? So just having that recurring check-in. And for me, this feels best quarterly on just hey, what's been new in the last 3 months? And anything major I should know about. Very open-ended question. What's keeping you up at night? Where's that pain? Some of the cliche. You can get a lot out of that and a lot of opportunity for advisory in that. And so again, we try to position ourselves to where we are very helpful in those recurring check-ins. But I do find that quarterly cadence is really nice for those. Let's take a breath. Take a step back. We've done the monthly thing. We got closed down. We're optimizing, occupancy and things like that on a more frequent basis. But now let's just take a step back and say, all right, 6 months into the year, where are we at compared to where we thought we'd be? And it just really helps reset expectations kind of around that. Last but not least, I want to touch on annually. What does this look like, right? And so this gets back to that entity owner planning. So this is really where I'm digging into do we have an estate plan together? What are our goals in terms of transition, exits? What significant investment changes are we trying to make? We do deep dive into that full tax planning meeting. We have the projections. Is there any transfers of ownership that may have different elections, like a 754 we need to consider? That all of that high arcing, okay, what do we need to do? Now we actually have to file the return. What do we need to do? Or, in a couple months we will. What do we need to do to fully optimize that tax picture? And then it's really looking at, have these monthly, quarterly systems worked? Is the data room fully optimized? Are we, at a place to where at year end, we can just snap our fingers and year end's done. We've got everything fully caught up. We can start the tax return on January 2nd. We're so up to speed here. But really having that almost a harder stop than the quarterly check-ins on what are the goals forward looking really look like. I kind of bifurcated into the monthlies, the now, quarterlies, a little bit of both. Annual is very much, all right, let's stop. Where are our goals? What do we need to shuffle around from the entity structure perspective, from the cash flow perspective to achieve our goals moving forward? And pulling all the right leverage to do that gives accountants a lot of opportunity for advising business owners. Because again, the point I want to kind of tie this back to, everything I've talked about is rooted in cash flow and numbers. That's the accountant's expertise, cash flow and numbers. So as data has become more and more readily available through AI, advanced technologies, the dashboards, whatever it is, how can we take that information, distill it in a way that the real estate professionals can understand, and we're adding value to it, and then be able to effectively articulate that. Creates an environment where we can add a lot of value. That is all I have. I hope you can tell I'm passionate about this stuff and love talking about it. And so you see my phone number and email address up on the screen here. I would love to talk about this more if you have any questions or any questions about what James Moore does, what Kyle does, how we implement this stuff. I'm happy to help and have a great conversation. So I'm going to hang on here for a couple more minutes and see if we have any questions that I can speak to. But I greatly appreciate you joining me today. Hopefully you got some excitement out of the 45 minutes. And thank you very much.
All right, I don't see any live comments coming in. So thanks everyone who is here live. And if you are, here's a quick reminder on how you can earn CPE if you attended today's webinar.
Today's event has ended. To earn CPE, go to earmark.app or scan the QR code on the screen. Then log in or create your free account. Search for the course by tapping on the magnifying glass icon on the home screen and then entering the name of this event. It takes a few days to make the course, so if you're attending this event live, keep an eye out for an email letting you know when the course is available. Pass the quiz to earn your CPE, then tap the button to email yourself a certificate. Stay tuned for more events from Earmark. Thanks for joining us, and we hope to see you again soon.